the golden rule here is there is a 12-month rule now. There is a 365-day rule now, which is black and white.
That's interesting.
Okay.
So now, that whole thing gets hit with active income.
Yeah.
Welcome to Real Talk with Gary. If you are listening to this show, that means you are either searching or ready to make a financial change in your life. This show is not only about real estate investing, but also the importance of mindset and the roadmap to a better, healthier life. Learn the daily routines of successful entrepreneurs and the latest market strategies and trends to stay ahead of the curve. Ready for some down-to-earth, north-of-the-border Canadian talk? Here's your host, Gary Hibbert.
All right, welcome back. And today I've got my good friend and accountant, Fabio Campanella, and he is a founder and head of tax, estate, and financial planning with the Campanella Group. Fabio's career has taken him down a very interesting path. He used to work at PricewaterhouseCoopers, Grant Thornton, Bank of Montreal, Nesbitt Burns, the international hedge fund industry. And he is a former personal finance columnist for the Financial Post, the Globe and Mail, the Toronto Star, and several other publications across Canada. Now, I mentioned all of that and all of his credentials because I want you to know who is sitting across the table from me in the studio. He's a wealth of knowledge. And today we dive into all the big changes that are happening in the tax world, from anti-flipping tax, the underused housing tax, the vacant home tax. To tell you the truth, I didn't even know there was a difference between those two there. The foreign buyers ban tax, and where's all this money going, right? So we touch on that and really what his thoughts are on all of these changes, because there's a lot of changes this year. And so very intriguing conversation, but more importantly, a very important conversation that everybody should listen to and be aware of. Now, what's happening in the market? What we're seeing right now is multiple offers are coming back, and they're coming back with a vengeance, at least out here in Durham region. This is what we're seeing on the street, and what we're typically seeing more of is more homeowners that are purchasing. We don't see a whole lot of real estate investors. Now, some of them are out there, obviously, but not a lot. And so here's what I'm personally doing with my particular portfolio with everything that's changed. And I talked about this at our last mastermind event, is that I'm selling one, potentially probably two of my properties. And Dan Patton and I, we had a conversation about this, is that, listen, selling is not failing. And if you had a stock and you bought it for 10, let's say you turn around now, you sell it for 20. Nobody ever say that, hey, you lost out, right? And so there's nothing wrong with, if you're in a position, and a lot of investors are in this situation right now where you're negative $500 or $1,000 or $2,000 a door. If you're in that situation and you're having a difficult time holding onto that property, sell it. It's okay, right? Because here's what I'm going to do. Is I'll just jump right back into the market. I've done this for many years. There's nothing wrong with repositioning, readjusting, and securing and making sure that you're stabilizing your portfolio. All right. So that's what I'm personally doing. And if you want to have a further conversation about that, give me a call, reach out to me. I'm easy to get a hold of. And before we get into it, if you're new to the podcast, thank you so much for joining. Go check out SmartHomeChoice.ca. It's our real estate education company. If you're thinking about getting into real estate investing or need help or attend any of our events, check that out. If you want personal mentorship, Darlene and I do this, and we've got 4 couples right now. We keep it very small, very tight. Our next one starts back up in September. So if you want a discovery call, you can go to garyhibbert.ca. And then last but not least, if you're enjoying the podcast, please leave a short review. And really what it does, it helps other people find the podcast. Because if you're enjoying it, hopefully they'll enjoy it as well too. All right. And with that, sit back, relax, and I will talk to you guys next week. Take care. Today's show is brought to you by Deep Pockets. Are you looking to borrow or invest funds? Deep Pockets is a preferred choice for secure lending. As a borrower, you have the option with flexible terms and repayment plans, as we have flexible credit criteria and income approvals. As an investor, you get to be the bank using your cash. You can use your RRSPs, your LIRAs, and even your TFSAs. Earn maximized cash flow or return with no out-of-pocket expenses. Fabio Campanella.
What's up, man?
Good, brother. Good to see you again.
Right? It's been a while since I've been here.
I know.
A couple of years.
It's been a couple
Before
years.
COVID.
Yeah, you're looking good. Working out.
Not really, but
No?
you know,
You're eating good though.
just
You've
not
always
picking out. I'm not picking out.
Okay.
That's the main thing. Right?
Yeah.
That's what I find works for me.
Yeah. You know what? I've said this a few times now. Like I've started doing yoga. I started doing it.
Yeah,
Oh man, it is. I actually went this morning with my daughter, so she went for the first time.
That's hard.
And she's like, "Dad, this is no joke."
Yeah. Do you do the hot yoga?
Yeah, hot yoga.
Yeah, that's what I do. I try to get there once a week.
Yeah.
It just it messes me up, man.
Yeah. But
It's the hardest workout.
But you know what I find though, now that I'm getting older, I don't need to build muscle. I just want to be flexible. Like I don't want to feel pain anymore. You know?
Well, it's a funny story. About a year ago,
Yeah.
I was starting to get into flexibility.
Yeah.
And I was like, I want to be able to do the splits, but not the easy one.
Yeah.
You know, not the front split. I want to do the side splits, like the Van Damme split.
That's
right?
just hard, Fabio.
No kidding, it's hard. So my fiance, who was like a competitive dancer for years, she's like, yeah, just dream on, you're not going to do it. So we made a bet, like a ridiculous bet, right? Where basically there's nothing that she would do. She would, it was just, I bet you can't do the splits. I'll give you a year. Okay.
Yeah.
A year went by. Okay. And I secretly went for 4 months to Oakville Gymnastics.
Yeah.
And like 2-3 times a week. And I had the gymnastics coaches just like ripping my body apart. Okay. I swear to you, maybe 1 inch of progress.
Yeah.
In a year.
That's crazy.
In a year.
Yeah.
Right. And it wasn't for lack of effort. It's just, it's that hard to be flexible, to get flexible in your 40s. Very difficult.
Yeah, no, it is for sure. I know because I try to do it, 3 times a week, and it feels like I'm making zero progress, and I've been doing it now for like almost 8 months.
The way that I see the progress for this kind of stuff is you're not getting worse.
Yes.
Because as you age,
That's
it's just going to keep getting worse and worse. At least you can stop getting worse.
Yeah, that's a good point.
To me, that's progress.
Yeah, that's a good point.
Right?
Good point. Okay, anyways, we're not here to talk about yoga today. No. We are here to talk about taxes. And you know what? Has there been a year where there's been this many changes? Because there's a lot this year, right? You've got the vacant home tax, you've got the underused housing tax, you got the anti-flipping, you got the foreign ban. Like that's a lot of shit. So
ultimately, every year, depending on what area of the economy you're looking at, there's going to be a lot of taxes introduced, taxes changed, so on and so forth, right? So from a real estate perspective, this year, there's quite a bit of change.
Yeah.
Okay. So obviously, this is going to be the absolute most boring podcast you've ever done.
No, we're going to make it fun. Yeah, we're going to make it fun.
Yeah,
we'll have some fun.
Cartwheels or do some yoga poses. I don't know, but this is probably going to be the most boring thing ever, but it's also important. So I don't want to get like super in detail with these things. I think that when we discussed about doing this podcast, you and I think the big thing is awareness, right?
Right.
And it's also the listeners and real estate investors or people that are potentially doing things in real estate, they need to be aware of these taxes and these new rules such that they can bring up the conversation with their accountants and their lawyers and their realtors and so on and so forth, so that they don't inadvertently get caught in a trap.
Right. Now, here's why we're going to make it fun, because I know that you're super technical. You're really good at what you do. And I love breaking things down into layman's terms, because I need to that's how I need to understand
it. That's what we're going to do.
Exactly.
We're going to break it down.
Okay. So let's talk about, why don't we dive into the anti-flipping?
Okay.
Because that was already there, was it not? Did they just add on to it?
Okay. So anti-flipping, there's always been a tax per se on flipping properties. Okay. So generally speaking, when you sell a property, it's either a business transaction or a business-like transaction or a capital transaction. That's the first thing you're looking at. All right. From there, you go on to different things. All right. So if it's a business transaction, that means that you are in the business of selling properties, and that property is usually a piece of your inventory. Okay. So you're a builder.
Right.
Okay. If it's a capital transaction, I want to give you a little bit of an analogy. All right. Let's say there's 2 people and they both own a tree, an apple tree. Okay. One guy sets up an apple farm, picks apples, sells the apples, picks apples, sells the apples, does this over the course of their career. 40 years down the road, they're like, I'm done picking apples. I want to retire. He or she sells the tree. The tree is capital to that person. The fruit that they were picking was inventory. When they pick the fruit and sell it, that's a business transaction. But when they sell the tree, it's a capital transaction, and hence they get capital gains treatment on the profit of selling that tree.
Okay. That's a good way to break it down.
That's the way I look at it.
Right.
On the flip side, this other business person buys a tree, okay, and says, I'm going to grow some apples. I don't want to be in the business of selling apples. That's annoying. I'm going to take out the seed from the apple and I'm going to plant seedlings and I'm going to flip seedlings. Right?
Right.
Okay.
So now he's flipping these trees.
He's flipping trees.
Right.
So if he sells that original tree, there's an argument that, hey, yes, and this is kind of butchered analogy, but he's in the business of selling trees. So it's not unreasonable to think that the sale of that original tree, right, is a business transaction, not on account of capital.
Right. So now he's turning that into inventory.
Exactly. The tree is inventory.
Right.
Not the apples.
Correct.
Because he's not selling apples. He's just taking out the seeds and planting seeds.
Exactly.
Okay. And it's kind of a butchered way to look at it, but that's the way I explain it to people, and it sort of makes sense to my clients.
So then what changed this year then?
Right. So what changed this year is you pick something you sell a piece of property, and generally speaking, the algorithm is it on business or is it on capital? Okay. If it's on capital, were you ordinarily inhabiting the property? Because if you were ordinarily inhabiting the property, then you can get an exemption called the principal residence exemption, meaning that, okay, it's a capital transaction. You ordinarily inhabited the property. You get the principal residence exemption. You have to report the transaction on your tax return. However, it's a tax-free transaction.
Okay.
Generally speaking, in a perfect world, that's how it always worked, right? Obviously, when you have such a lucrative rule, people are going to take advantage of it. Okay. So that's where they introduced kind of like an anti-flipping tax, meaning that you must, if you've sold a property, okay, within a 12-month period, you're automatically caught by this. Okay. Automatically. So I'm going to just pull up some
what about
rules.
Primary residence?
So now this is where we start getting into the area where you need to make an exemption. Okay. So I'm going to just pull up the exemption because I don't have these things memorized, and we're going to be covering a lot of topics. So I apologize for that.
No. I'd rather you have it correct than not. Right. Because there's a lot in there.
Yeah. So this is from the budget in 2022. Okay. But it's in force now, the rule. Okay. So generally speaking, like you said before, was there an anti-flipping tax, or was there a way to treat an anti-flip? Yes, there was in the past, but it was, you can actually read the guidance on the CRA's website, and it was basically rules based on CRA interpretation of the law or the minister's interpretation of the law, along with many well-developed court cases that have passed through the tax courts and higher courts in Canada, right? The big things that they were looking at were like, okay, listen, you bought this property, you sold it for a profit. Is it capital or is it business income, or something like that we would call adventure in the nature of trade, which is treated like business income, right? They look at a bunch of different factors, okay?
Right.
So
and when we say business income, for somebody who's listening, that's like active income. This is getting added on to
dollar for dollar under your tax return.
Right. Got it. So whatever tax bracket you're in, if you flip that tree, we're going to use this tree analogy. I think that makes sense. This gets added on to your income, which now could bump you up into a higher tax bracket.
Yeah. Well, the big thing is that the full gain is taxable rather than half the gain, because the inclusion rate for capital gains into your income is 1/2. So it literally leads to double taxation.
Right.
Then we're not even going to get into this, but there's also HST issues. Okay.
Okay.
But that's way beyond the scope of what we're talking about today. So the biggest consideration, at least in my opinion, is the intention. What was your intention when you bought this particular property? Okay.
Mm-hmm.
Then they get into something like your nature of business, your profession, your calling, so on and so forth, right? If you're a realtor or you're a known property flipper, that's a strike against you. If you're a little old lady who just bought her first or second property, that's a strike against the government. You know what I'm saying? So it's like on a balance of the facts. The extent to which borrowed money was used and the sophistication of the borrowed money. Did you get a private loan to make the down payment? Did you get investors to give you private mortgages? Did you get, complicated lending, right?
Right. Yeah, so they're really kind of digging into the person that's doing this flipping. How sophisticated are they? Where are they getting the funds from?
Exactly. Factors motivating the sale, right? Did you buy a property and then flip it because you were diagnosed with a brain tumor? You know what I'm saying? And then the other thing was the length of time of holding the real estate. The shorter the length of time, the more the argument was for business. The longer the length of time, the more it was argued for capital. And this is where they've decided to put a hard stop. Okay. They're like, all right, all of these factors still come into play. And there's many, many, many more factors. It's not that simple. All of these factors still come into play. However, if you've bought a property and sold it within a 12-month period, we're automatically going to say this is a business transaction.
Got it.
Unless you meet a couple of exemptions. So a flipped property is literally defined now. It's located in Canada, okay? Would not otherwise be inventory of the taxpayer. So you're not a builder, just a regular person, okay? And was owned by the taxpayer for less than 365 consecutive days prior to the disposition of the property. Simple definition. Okay. Has to be in Canada, not somewhere else. Okay. It would not otherwise be inventory. So, and then you've had it for less than a year. Okay. I want to put a pin right here before we get it more technical. Okay. And I want to talk about why all these rules were likely come up with, right? Obviously, we've had a hugely overheated property market in Canada. Hugely overheated, which has extended over a couple of decades now. Mm-hmm. Okay. So there's good and there's bad from an economic perspective. Now, I am not a statistician and I am not an economist, right? But I know enough to gauge what's going on out there. So when you have an overheated housing market in a developed market like Canada, you are going to get a huge benefit from that because you're going to get foreign money coming in because they see an attractive capital appreciation opportunity, right? They also see a stable country where it's stable to put your money into a country like this rather than, let's say, nothing against Argentinians. I love Argentinians, but you pop your money into Argentina and you don't know what the inflation rate's going to be, right? So it's an attractive place to put your money if you're a foreigner or if you're a Canadian. And it stimulates the economy. Houses don't build themselves. They require architects, lawyers, accountants, engineers, manual workers, marketing people. It stimulates the economy pervasively.
Right. There's a whole machine behind it.
It's a whole machine of a lot of people making an honest living and feeding their families, right? So obviously the government wants to have a stable and growing housing market, right? Plus, we want, we have a massive country with no people in it. We need to bring in immigrants because guess what? They're not going to come up, you and I are not going to have 6 children.
Those days are over.
Those days are gone, right? So we're not going to get a baby boom from Canadians that are here. We need to bring people in. And what's the first thing that people need to do? They need to live somewhere. So we need housing. So obviously, when you have a government policy to increase housing, right, you're going to have capitalists such as you and I and other people who have way more resources than you and I come in and take advantage of that, right? So you're going to get a lot of foreigners popping money into it. You're going to get a lot of speculation, right? And you're going to get some unintended consequences to those actions.
Right.
So we've come to the point now where we cannot ignore those unintended consequences. One of those unintended consequences is rapid appreciation in the value of the homes and pricing out the average Canadian in large metropolitan areas. Okay. Right. That's number one. Number two is people squatting on homes. They're like, I don't care. I don't want to deal with being a landlord. I just want to park my money. I want to take my money out of an unstable country, put it into a stable country, not in a bank account, but in an asset that I think is going to appreciate. And I'm just going to leave it there.
Right. And these would probably be some investors that are not in Canada where now they're like, look, I'm not really overly concerned about return on investment, return of investment. So I'm going to just park my money in this property. Let it sit there because I know Canada is a stable marketplace.
Exactly.
Right.
The other thing is money laundering, right? There's likely a lot of money laundering through Canadian properties, which then gives the unintended consequence of parking homes vacant, okay, and artificially increasing the prices and pricing out Canadian citizens, Canadian residents from the housing market.
Right.
Okay. So all of this has culminated in the last couple of years, really accentuated in the price increases in during COVID, right? Rents have been jacked up because there's less supply, more demand. Basics. This is economics 101 that you learned first year in university.
Right.
Okay. So what are they doing? They're implementing a bunch of targeted rules to stop the unintended consequences of their policies, right? So it is the right thing to do, probably a little bit too late, but who am I to comment on that?
Right.
Okay.
Now, you did touch on the vacant home tax as well, too. Do you want to kind of dive into that now? Or do we want to talk about the exemptions with the anti-flipping?
Let's take a look at the exemptions. So you've bought a property, you're not a developer, and you've sold that property in less than a year, okay? Right away, you've got to be thinking, okay, I'm getting hit by the flipping rules.
Okay.
Right.
Now let's touch on that year. What if it's a year and a week? Are you out of that?
The way that I'm reading the rules is 365 days.
Got it. So if it's 366, I'm good.
You're good. Not necessarily. You go to the old way of looking at it, where you go through the checklist.
Right. Now, are you doing this as a business? How active are you? Got it.
Exactly. Okay. Which is, once again, a bit beyond the scope of what we're talking about today. Mm-hmm. We're going to concentrate on, black and white. Right? It's located in Canada. It's not your piece of inventory, and you sold it within 365 days. Okay. So what are the exemptions? Right? Death of the taxpayer or related person. You or your spouse or your child dies, they're going to leave you alone. Okay. Related person joining the household, birth of a child, adoption of a child, or the care of an elderly parent. Okay. Breakdown of a marriage or common law partnership, divorce, separation.
Do a lot of people use that? Like, you know where I'm going with this, right?
I know where you're going with this. Yeah. That would be aggressive tax planning or tax avoidance, which would be, if it's false or fake, then you could get hit by GAR, or the general anti-avoidance rule. Right. Once again, that's a little bit advanced for this, but they've thought about that, I'm sure.
Yeah, for sure. Okay.
Threat to personal safety of the taxpayer or related person. I don't know what the hell that means.
Okay.
Disability or serious illness of the taxpayer or related person. Somebody gets diagnosed with cancer, has a stroke, blah, blah, blah. They leave you alone. Okay. Eligible relocation. You have to move at least 40 kilometers closer to your new place of work.
Okay.
Okay.
Yeah. So like a job relocation.
Got it. Involuntary termination of employment, you got fired, or your spouse. Okay. Insolvency, obviously, if you're bankrupt, you have to sell the house.
Yep.
Okay. Or destruction or expropriation of the property against the taxpayer's will.
Okay.
Okay. So obviously, they're going to give you some exceptions, obviously. But if you don't meet those exemptions, you have to be prepared, right, to dive a little bit deeper. So this particular rule is here. Why? Because they want to stop people from flipping properties. As a side note to this, I believe, I don't know if it's law yet, but they are putting something through that deals specifically with assignment sales of pre-construction properties.
All right.
Okay.
Yeah, where they're flipping paper.
Right. And what I want people to understand is if you bought a property pre-construction and you held onto it for 4 years, okay, and you sell it, right, you're going to be caught under the assignment rules. But then as soon as the property closes, the clock starts reticking for 365 days. Okay.
Oh, really?
There's 2 clocks.
Okay.
That's how I read the rules. That's how I understand the rules. Okay. So the golden rule here is there is a 12-month rule now. There is a 365-day rule now, which is black and white.
That's interesting.
Okay.
So now that whole thing gets hit with active income.
Yeah. Now, there's also possible HST issues. If you've renovated the property, okay, you may have to charge HST on the entire sale price.
That's crazy because, there's a lot of people, especially now in the market with what happened last year and the rise in interest rates, and people are sitting on these condos that had zero intention on closing on them. Yes. Right. And now they were going to, just flip the paper. Yeah. And now they're going to get hit with this.
And if you think about it logically, they had zero intention of closing, or they had an intention of renovating and flipping. That's fine, but it's a business, right? It's a business, and the rules, they're not going to get taxed to the point of a loss.
Right. They're making money.
They're making money.
Right. But the big difference now is that they've got to hold it for a year, because before it would have been capital gain, depending on obviously their situation, on how they were running their business.
Basically, the rules are, in my opinion, they're the same. They've introduced a hard stop at 365 days.
Got it. Okay.
But the rules are the same. If your intention was to flip it, this 365-day rule is irrelevant because you're still under the business income.
Right. Okay. Let's dive into the underused housing tax and then also the vacant home tax, because there is a big difference between the two.
Correct. Okay. So there's now a vacant home tax in Toronto at the municipal level, and there's an underused housing tax at the federal level. And these are very different taxes. Okay. And people have often confused them. I even confused them at first.
Right.
Okay.
Because they sound the same.
They sound exactly the same.
Right.
Okay. So in the city of Toronto, there is, if you're talking to any, especially younger people in their 20s or whatnot, or people just immigrating to Canada looking for a place, at least I am hearing, it is difficult to find a place to rent, like a good quality place to rent at a decent price. Okay. Mm-hmm. And I'm not going to make arguments on either side of the equation where, the landlords are like, hey, I can't be losing money. They jacked up my mortgage rates or whatever. I'm not here to to argue that. I'm just talking about the facts. Okay. Apparently it's difficult, right? I don't know because I'm not out there trying to rent a place, right? With that being said, the city of Toronto has implemented a number of rules. All right. And it started with the short-term rental rules, where they're like, hey, listen, you can short-term rental or Airbnb your property, but it must be your property, and you can't do it for more than 180 days per year. And you have to pay the city a tax, and so on and so forth. They're like, hey, we don't want everybody creating a hotel. Right. Okay. And ruining the market because, then nobody's going to offer a long-term housing solutions, which we need those long-term housing solutions. So from a political perspective, we have a high demand, a low supply, and a human need for people to have safe and affordable homes to live in. Okay.
Right. Yeah.
So the politicians, obviously, they have to address this situation. They've come up with the vacant home tax. So everybody in Toronto that owns a house, you apparently got to file this vacant home tax thing. Super easy. You do it online. Okay. And what they're looking for is a house that no one is using.
Okay. And what was the period of time? Was it 6 months?
I believe it's 6 months. Okay. If you are not using a house, and there's exemptions, right? I could pull them up, whatever.
Yeah. But the first one that comes to mind that I can think of would be my cottage. It's a 3-season cottage.
Yes.
Right? It doesn't have heat all year round, or it doesn't have running water for sure.
All year round, yeah.
Exactly. Yeah. So that would be exempt, I would assume.
Well, that's not in Toronto.
Got it. It's only Toronto.
This is Toronto specifically. Okay. Everybody's got running water. Everybody's got heat.
Got it.
Okay. you don't have a cottage in Toronto. You know what I'm saying?
Yeah.
So they're not playing that game. What they don't want, what I believe what they're looking for, okay, are people that are just have a place that's sitting there idle, right? Or foreigners who are just parking their money in condos, doing nothing.
Now, what do they consider Toronto? Toronto, GTA? Are we talking
the
Mississauga?
city of Toronto? Like
okay, so just a city.
Where the municipal region of Toronto, where wherever Toronto collecting garbage.
Got it. Okay.
You know what I mean?
Yeah.
Basically.
Okay.
Wherever you're paying Toronto property tax. Okay.
Beautiful.
A couple of exemptions to this. And it's I believe it's 1%. The tax is 1% of the tax, your tax assessment, your property tax assessment.
So not like say the retail or market value,
no, that would be too difficult.
Value.
That would be too difficult. I believe it's the assessed value. Okay.
Which is better.
Yeah,
at least
better,
it's going to be
still,
cheaper.
Like, a condo would be assessed at like $500,000. So that's $5,000 a year. That's a lot of money, right? So death of a registered owner, obviously. Repairs or renovations. So if you're renovating the property for a long period of time, you get an exemption. Principal resident is in care. So like healthcare, whatever it is, they're not going to screw you on that. Transfer of legal ownership. You bought the property, sold it 4 months into the year. Obviously, you didn't hold it you weren't living in it for 6 months. Occupancy for full-time employment. This is the one that's weird. I'm going to read it to you. The vacant property is required for occupation for employment purposes for a total of at least 6 months in the taxation year by its owner and who has a principal residence outside of the GTA. Okay. So you work in Toronto for 6 months, but you own a property outside of Toronto.
Got it. Because you're maybe doing some business in Toronto, whatever it may be. Could be seasonal.
There's just some people that have that situation. Okay. Or there's a court order that you can't live in the house or for whatever. Okay.
Yep.
That is the Toronto vacant home tax, not to be confused with the underused housing tax, which is something completely different. It is at the federal level.
Okay.
Got
it. So then let's dive into the underused housing tax.
Okay.
Because that's obviously a big one because everybody has to do this, correct?
No. CRA.
Okay.
So I'm just going to actually pull it up because you're going to be asking me a bunch of questions that I don't have memorized. Okay. So underused housing tax, it is a tax on 1% of the value, the assessed value of the property. Okay. For a vacant or underused home. Okay. This is at the federal level.
Okay.
So it's all the way at the top. And let me just pull up something here for you.
Now, is there a deadline for this?
Yes.
Okay. And what's the deadline? April 30th?
Yes. So in essence, what happens here? Okay. Everyone in Canada is subject to this tax, or every, let's say, house or property is subject to this tax. Okay.
So even your personal residency?
Everything. Any house.
Okay.
It's a house, you're subject to this tax. If it's a residential property, you're subject to this. You're potentially subject to this tax.
What if I have an additional unit in my basement that I rent out and now I stop renting it out?
No, it's based on, my understanding is it's based on registry, like the registered use of the house.
So the deed okay.
Yeah. Okay.
Yep.
All right. So I actually have a list here. So unless an exemption is available, the UHT applies to residential properties located in Canada. Residential properties include detached houses containing up to 3 dwelling units, so up to a triplex. Okay.
So then after that, you're fine. So if I got a fourplex, I don't have to worry about this.
I believe so.
Okay.
Yes. Semi-detached homes, row house units, residential condominium units, or any other similar premises intended to be owned as a separate unit or parcel. Okay.
So then
and then here they have further definition. A dwelling unit is generally a single unit within a residential property that contains its own kitchen, bath, and living area. Okay. So let's just use some.
Sorry, say that one more time. So
a dwelling unit is generally a single unit within a residential property that contains its own kitchen, bath, and living area.
Okay. So then could that then be if it was a 2 unit? Yeah, it would be.
Yeah. But that would still be caught under this.
Right. Got it.
Okay. All right. So what happens here? You have to see if you are an affected owner. You have to see, do I need to file this particular filing? Okay.
And how difficult is it to do this? Like, is it just online, or can I have my accountant do this for me?
Yeah, you can do it yourself. You can have the accountant do it. There's a form UHT 2900 that you can walk through. It's pretty budget.
Okay. Did you see that one video that I did talking about accountants? And T264589 or something. But yeah, what I was really going with that video was like, listen, don't try to be an accountant. Just go talk to your accountant. Let your accountant help you with stuff.
Yeah. We sent out an email blast on this to all of our clients. And it's like, listen, we kind of don't want to do it for you.
Oh, you don't?
But because it's like, I feel bad because like you could kind of do it yourself.
Because it's simple enough.
Yeah.
And you're probably going to charge them a lot more for...
Yeah, because of the liability, let's start with this thing. You got to take this law seriously, and you got to take the filing seriously. Why? Because the penalties are ridiculous.
Okay.
Filing late.
What do you mean when ridiculous? Like, how ridiculous are you talking?
I don't know, I can't remember if it's per filing or per person or entity. If you own a property and you were supposed to have filed for this particular property and you don't file, it's a $5,000 penalty.
If I don't file by April 30th?
Yes, it's a $5,000 penalty. All right. If you don't file and you are a corporation, it's a $10,000 penalty. So it's significant penalties.
So if your property, now you've bought your property in your holding company or your corporation, $10,000.
$10,000. Okay.
Now, do we get to do this every year?
Every year for every property.
Jesus.
And if there's two owners, my understanding, husband and wife, 2 filings. So husband and wife own a property, right?
Yeah.
And they forget to file, $5,000 penalty each. That's my understanding of the rules.
Is this to try and get some of this money back with the whole COVID thing? And
there's all kinds of conspiracy theories about this. But ultimately, I think that there's going to be an uproar. So there's already been an uproar in the tax community about this because they're like, why did you make this an April 30th filing? This is absolute stupidity. The accountants have no time to file this crap. All right.
Yeah.
We don't have time to file this shit. Okay. So they extended the period of time for this year, I believe until October 31st. We can look it up after, but they extended the period of time whereby they will not hit you with a penalty. It's still due April 30th, but if you file by, I believe it's October 31st, they're not going to hit you with the penalty. So they gave us a breathing period.
So this is now you file October 30th. You didn't do the UHT filing.
2900, yeah.
Okay.
So,
and then they find out, like, do they have people now that they've hired to take a look into your holdings and what you have to say, oh, hey, hold on a second. You've got 4 of the properties. What's going on here? We need you to file.
I don't think they've taken it to that level. That would actually be very difficult. They would have to get land registry and blah, 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 blah,
yeah,
blah. Right.
And that'd be a lot of manpower.
Right.
And woman power.
It's not going to be easy.
Okay.
Okay. So one of the issues here is, do you need to file? Mm-hmm. Okay. If you are a Canadian, and I had this here and I want to give you the actual, if you're a Canadian resident, a Canadian citizen, and you own some properties, you don't need to file. Okay. However, if you are a Canadian controlled private corporation, like or a small corporation, like a non-listed corporation, okay, or you are holding a property in trust for a corporation or for someone else, other than being the estate trustee to a deceased person, okay, or if you are a member of a partnership that owns a property.
When you say partnership, just to clarify, not joint venture, we're talking partnership.
And this is where it becomes difficult. Is a joint venture considered a partnership or a legal co-ownership? I consider it to be a co-ownership as per my discussions with various different lawyers. But partnership is something completely different, right? So if you've been reporting a property on your T776 for many, many years as a partnership and jointly taking CCA or depreciation, I guess you're a partnership, and each partner must file a UHT 2900.
Right. Even though their name isn't on title, they've got a joint venture agreement.
So the joint venture agreement
that they're using to file their taxes each year.
But if they've been reporting it as a partnership, if they've been reporting it as a co-ownership, they may be safe because that's a co-ownership of an asset rather than a partnership. A partnership is something specific to the law. It's we have jointly come together to look for a profit on this particular thing, and we're reporting it as a partnership. So when you take a look at your tax return on the T776, this is on your personal tax return, okay? On your T776, you have two boxes to click, co-ownership or partnership. For the most part, most things, if you own a property jointly with your brother and you guys rent it out, right? Or with your buddy or your wife or whatever, for the most part, you are just joint, tenants in common or joint with rights of survivorship, okay? To me, that's co-ownership of assets. So I click off on co-owner, not partner, right? But if you formed a partnership.
Now, hold on, just to clarify that. And so now I click off on co-owner. I don't have to do the under.
That's my understanding of this. You're Canadian citizen, Canadian resident. You're a co-owner of a property. My understanding is you do not have to.
Okay, so just use me as an example. So I've got a partnership. Well, not a partnership, but I've got a joint venture with a brother.
Yeah.
I don't have to do this?
It looks like you do not have to unless the wording in the joint venture agreement is designed to look like a partnership. Okay. Which, once again, that's a legal question, which I'm not really qualified to answer, right? However, what I think they're looking at is, hey, let's say we go out and create a, for example, a partnership of corporations, or a limited partnership, or a limited liability partnership. These are business entities. I think what they're trying to say is, if one of these business entities purchases a property, that's a partnership that owns a property. Okay. So if you've specifically set up a partnership and you have a partnership agreement.
So I now have a corporation. I've gone to my lawyer. I've gone to my accountant. I've created this corporation, and now I've bought a property.
No, not a corporation. It could be, so corporations can form a partnership or individuals can form a partnership, right? But you've gone out and said, we are forming a partnership, and as partners, we are going to start buying properties. Okay. So there's a formal partnership drawn up, and you have a partnership agreement, which is very different from when I read the joint venture agreements that are out there. Those look like, hey, we're co-owning this asset, but we're not partners in some sort of a business. We just co-own this asset.
So then is it fair to say there'd be a limited amount of people that would be impacted by this?
I would hope. Yes.
It doesn't sound like there'd be a lot, right? These would be people who set out, me and you sit down and say, hey, Fabio, we are now going to go out and we're going to buy properties. This is who this would impact.
Yeah, like we're literally going out and we're forming a business,
right?
Which is the Gary and Fab partnership, and we're going to go out and buy properties.
So I got I got the corporation, I got this holding company, I got the property management company. This is what we're doing.
We're forming a business.
Got it.
It's not, hey, Fab, do you want to get in on this one particular property, and then we'll rent it out and we'll be co-owners and blah blah blah. That's something different. This is at least my understanding. And let's all take this with a grain of salt, because each accountant, each lawyer is going to have a different opinion on this. Mm-hmm. And, I've taken a couple courses on this and I've seen different opinions on it. And nobody's filed anything yet, or at least people have filed, but, I don't think many have been assessed yet. So, and certainly I've never heard of anybody being audited on this thing yet. So I don't know how it's going to pan out. Okay. The idea is, if you are a foreigner, who has bought property, you're not Canadian citizen, not a resident, you are a member of a partnership, you are holding the property in trust for someone else or for a corporation other than being the estate trustee, you're probably going to have to file a UHT.
Right.
Okay. So you don't necessarily need to pay the UHT tax, but
Right. You got to file it.
Yeah.
So this would be like even like, say, like a company like BlackRock. This is what they do. They go out and they're buying properties.
That's different. They have an exception.
Why?
So public companies,
they're above the law.
Yeah, public companies and I think it's like REITs and things like that.
Oh, okay.
They have an exception to this. Let me just pull up. Let's see if I can grab this. I want to pull up some of the real.
So I'd also assume then too, like investors who are going out and buying multifamilies. What if
that's different, right? Because
if they're raising capital,
yeah,
right, that's different as well too. So it wouldn't fall under that.
No, I don't believe it does.
Okay.
And a multifamily is different, right? Because here, the UHT applies to residential properties located in Canada. Residential properties includes detached homes, semi-detached homes, row house units, residential condo units, and any other similar premises intended to be owned as a separate unit or parcel.
Right, because triplexes, I think, in higher were exempt as well too. Correct.
Now, then what the other kind of complication is? Let's say you have a multi-unit residential, and each unit is a separate unit, is considered a separate legally owned unit.
Almost kind of like a condo. Or,
do you have to file for each separate unit?
Right, because they've got their own deed.
Exactly. Right. So that's another complication that I have not even thought of and I haven't even run into yet, but I do have some clients that are going to be affected by that. So obviously we were all panicking with this, but because it was an April 30th due date, but now they've extended it. So in essence, what I want people to kind of get out of this is this tax exists. I don't want to go into all the details because it's going to be beyond the scope of what each individual listener is going to want to get out of this. But the idea is you need to be aware of this, and it's a huge penalty, and you need to start the discussion with your accountant. And I would say just start the discussion May, June, right? So that you are well within the time frame to file before the false, secondary deadline.
Yeah, got it. Okay. So let's touch on the last subject here, which is the foreign ban. I think we can probably get through this fairly quickly. But,
yeah. So for sure. So let me just pull up some.
Yeah. And that's been introduced this year as well too. And it's a 2-year ban, correct?
I believe it's a 2-year ban. So it's effective January 1st, 2023.
Yep.
I'm going to read you some of the highlights here. Okay. So the act defines residential property as buildings with 3 dwelling units or less. Okay. So like a triplex. So,
and again, this is to help with housing. This is essentially what they're trying to do.
They are trying to stop the artificial increase in the value of houses for regular Canadian families by foreigners who are trying to pop cash into Canada, and it's artificially increasing the value.
But we don't think this is like a huge percentage. Like, what are we thinking? Maybe 3 to 5%.
The problem is, if you look at, in my opinion, if you look at the market, right, you're only as good as your last trade, right? So let's think of something even simpler. Let's say TD stock. Okay. Let's say there were no regulations on how much you can uptick or downtick a stock on a stock exchange. Okay. I could easily manipulate the market by putting in a bid for TD stock at $50 more than the current going price of it, which would start a chain reaction of increasing prices systematically on all stocks. Okay. In a similar fashion, I can create an artificial increase in the value of homes by going into an area and artificially buying a home for more than it's really truly worth intrinsically.
If we got the capital, right?
If you got the capital, right? As a foreigner to Canada, if I pop my money in, get my appreciation, whatever, pay a little bit of tax, transfer my money out back to my tax haven in wherever. I don't care what happens systematically to Canadians, right? So we're not playing with stocks here. We're playing with people's homes. And what happened here is, you get 2008, 2009, huge crash in the market. It's going to ruin the economy. They enter into quantitative easing in the United States, and it starts a ripple effect across developed markets whereby we, one of the components is we start reducing interest rates in order to keep the market going, in order to keep the economy stimulated. That reduction in interest rates is going to make us as Canadians more able to afford an inflated priced home, because we're just looking at the monthly payment, right? Mm-hmm. So if I can afford the monthly payment and pay it off in 25 years, what do I care that the home has gone up in value, right? And I'm buying a house for $1 million when it's really worth $600,000. I can afford it because we think in North America, we think in monthly payment.
Right.
We don't think about the price.
Okay.
Right.
So do you think any of these changes that they've put in is going to make a difference?
I have no clue.
Okay.
Do I think that any changes the government makes make a difference? Yeah, but there's going to be unintended consequences as well.
What do you think some of those might be?
Yeah, I don't know. I think that they might artificially shut down the market. I think that there's probably a lot of foreign, I'm not opposed to foreigners buying property in Canada. I think it stimulates the economy. There's going to be a commission to you. There's going to be work for an accountant. There's going to be work for a lawyer. There's going to be work for an architect for renovations. There's going to be a home that maybe people who don't want to buy a home can rent, right? So I think that there's a lot of benefit to it. What I don't want is money laundering.
Yeah. I mean, today is April the 5th.
Yeah.
Okay. So we're going to release this probably in a couple of weeks. And I can tell you right now, in the marketplace where we are, multiple offers are coming back again. Homes are coming out. They're holding off on offers. So it doesn't even look like any of this has done anything, which is wild.
Well, this is the thing. So once again, we go back to the key highlights here. The Act addresses 3 dwelling units or less, which is primarily what you guys are dealing with, what your listeners are dealing with, right? Non-Canadians can purchase residential properties located outside of census metropolitan areas. Okay, so like in the boonies, go ahead and buy, all right? Certain exemptions allow non-Canadians to purchase residential property in defined circumstances, right? So obviously there's going to be exemptions, right? And if a non-Canadian or anyone knowingly assists a non-Canadian is convicted of violating or the prohibition, they will have to pay a fine of up to $10,000. Additionally, a court can order the sale of the residential property.
Right.
This last point is what happens often. Somebody will be sent to Canada, a student or something like that, and then they're starting to buy properties, right? But they're buying properties in trust for foreigners or somebody else.
Yeah, they're here to do some schooling, and all of a sudden now they got 10 properties in their name.
Exactly.
How did you?
Exactly.
Right.
So there's another rule that we're not looking at here, and I want to respect the time limit here, but it's the trust reporting rules. So oftentimes what will happen is somebody will buy a property in trust for someone else. Mm-hmm. They haven't formally set up a trust, but it's something called a bare trust. Okay. You now must report those bare trusts, whereas before you never had to file a return for those. Now we have to file an information return for those because the government wants to gather data on who is the true beneficial owner of all these properties.
Got it. Okay.
So I think to summarize, the government has addressed the issue of a lot of foreign buyers, a lot of speculation in the housing market. It's affecting the lives of Canadians, right? So they want to make targeted rules that target those specific things. Foreign buyers, vacant homes, underused homes. They're like, hey, listen, we have no problem with you buying a property. If you're a foreigner, you got to pay a little bit of tax if you want to enter our market, okay? If you want to hold a property vacant, no problem. Pay Canada some sort of a tax so we can return the money to the people that need it, right? Or rent it out to someone.
One last question on that then. So they're definitely trying to get more income coming into the government, obviously, by introducing all these different taxes. Have you been told, or do you know where they're trying to put this additional funding? Are they trying to put it into affordable housing? Have they come out? There must be some type of formal statement out there.
In all honesty, that's beyond the scope of what I do for a living.
Okay.
Let's be very, very clear what I do for a living. I don't write the laws. I don't comment on them. I don't care. My job is to learn the laws and learn the way that these laws are reported and structure your situation in the most advantageous way for you without breaking the law.
Got it.
So I don't care what they're doing. Not that I don't care. Obviously, I care. I live in Canada, but I am not concerned. That's not my job. That's the job of, political scientists, economists, social scientists. They're more concerned with that.
Right. You're looking out for the well-being of your client, making sure that they're filing the right forms and they can continue to move forward and conduct their business.
And increase their net worth on a year-over-year basis. That is my only concern.
Got it. Okay, Fabio, with that, anything else that we need to touch on with all these taxes here, or any last piece of advice that you'd want to share on this, on everything that's changed this year?
My last piece of advice is the advice I give everybody, right? Because once again, my practice isn't just a tax practice. It's a tax and wealth advisory practice. So it's an integrated practice. I always tell everybody, tax is a secondary, has a primary effect on your wealth, but it is a secondary consideration. Do not make a tax motivated move. Make a business motivated move. If you are making money and something is a good investment or a good business, go ahead and do it. We'll structure it from a tax perspective after you've made that move, or after you've decided to make that move.
Right.
Okay. If it's a good move, it's a good move. Don't let tax discourage you from starting a good business, buying a good quality property, so on and so forth.
Right. I like that. And you know what? I think that's a good segue into us doing another podcast on infinite banking and wealth building.
Let's do it.
All right, brother. Listen, thanks for coming in. I appreciate it. If people want to learn more about you or get in contact with you, and for them to have you as their accountant, how do they do that? So
you can go, the best way to get to check us out is CampanellaGroup.com.
Okay.
Check us out there. We take a very, very limited number of new clients because we want to keep a very tight client group, and we want our clients to be similar. Right. We want all of our clients to be similar so that we're not dealing with things that are disruptive to the practice, so that the client gets the best service. Right.
All right.
And you'll get all that info from the website.
Awesome. Fabio, always good seeing you, brother. Awesome, I appreciate it. Take care. Today's show is brought to you by McMurder & Associates. McMurder & Associates is a real estate and estate law firm who can be your legal partner for every major event in your life. If you are planning your estate, selling or buying a home or an investment property, they can definitely help. With over 30 years of experience, the firm's objective is to prevent you from worrying about the legal aspects of your transaction. From the beginning, McMurder & Associates will provide you with straightforward legal advice and a no surprises policy where you won't be hit with a legal bill you did not expect.
Thanks for listening to today's show with Gary Hibbert. Please don't forget to subscribe, leave a review, and connect with your host on Instagram @GaryHibbert. Until next time, stay mindful and remember, you don't have to be great to start. Just start, and you'll be on the path to being great.